In Lecture 1, I gave you some evidence to make the point that it's really tough to beat the market consistently. Today I'm going to delve into that a little more because some people reason this way. Every year, they say, some companies do much better than others, and if you do enough reading and watching the business news, then you can identify them in advance. These people think that will translate into doing better than the average guy who doesn't take the time to do much research. Let's think about that. You read a book published, say, 10 years ago about a trading strategy that's supposed to work. Maybe it says you should invest in small growth stocks. Then you read an article on the internet that was posted a month ago about a firm called, say, the Small and Growing Company. So you ask some questions and learn that small and growing does indeed fit the criteria listed in the book and on the internet, so you decide to buy. What's wrong with this story? I'll tell you what's wrong. I've never mentioned the price. Small and Growing Company might be a great buy at $10 per share, but it's probably not a good buy at $20 per share. There's nothing new or hard about this. We see it in other markets all the time. A new Mercedes might be a great buy at $30,000, but it's probably not a good buy at $130,000. People who advocate buying a certain class or type of stock usually don't factor in how often stock prices can change. While you're walking around doing your research, the price can adjust to reflect the traits of small and growing company, be they good or bad. Any strategy that claims to pick investments that will outperform other investments of comparable risk without considering the price is automatically suspect. I'll tell you another thing that's wrong with the idea that if you just do enough reading and asking around, then you could do better than the average investor. That conceptualization of the market fundamentally mischaracterizes the nature of the activity. Buying stocks isn't a me against you contest. People tend to think of picking stocks as a game with winners and losers, and in most games, the winner just needs a slight edge over his opponent to win. Yes, competitive games usually feature two competing players or teams. I play you in tennis, or my football team plays yours. In head-to-head competition, the side with a bit more talent or a bit more preparation usually wins. Small edges matter. It's easy to think that if I work a little harder than you at picking stocks, then I'll beat you, just like in other competitions. That's the wrong way to think of it. If you want to think of investing as a contest, then think of it as an information processing contest. The task is to gather information about a company, distill that information into a price, and then buy the stocks with prices that are too low given the available information. What's more, the competition isn't me against you. It's you against the collective wisdom of the marketplace. Now, let's think about how the marketplace produces the stock price we see. Mark Rubenstein, a professor at the University of California at Berkeley, writes that each investor buying and selling, for whatever reason, unwittingly pushes prices to where they reflect that investor's information and analysis. Professor Rubenstein thinks of the stock market as an enormous, continually operating mechanism that records the opinions of millions of investors in continuously changing prices. If you think of the market like this, then it's silly to think that prices can get too far away from fair. After all, aggregating information from lots of individuals has a track record of finding the truth in other fields. Do you remember the tragic story of the USS Scorpion? Sherry Sontag, Christopher Drew, and Annette Lawrence Drew's book, Blind Man's Bluff, The Untold Story of American Submarine Espionage, tells the tale. On May 27, 1968, the submarine was officially declared missing, with her contingent of 99 men presumed dead. All the experts could do was narrow the disaster site to a 20-mile-wide circle in the Atlantic in an area far below the depth that would crush the hull. For the next 5 months, experts searched extensively, but to no avail. The Navy's top deep water expert, Dr. John Craven, was at his wit's end. Finally, he asked a group of submarine and salvage experts to bet on the probabilities of different outcomes. He took the average of their responses. You know what? They found the remains of the Scorpion just 220 yards from the average of the estimates. The collective wisdom of the team produced a much better guess of the truth than any one expert could develop. The rules of stock trading also argue against the you versus me conceptualization. The way the stock market is structured ensures intense competition among buyers and sellers. Buyers don't get to pick their seller, and sellers don't get to pick their buyers. Buy and sell orders at the market price get matched. Traders never know who was their trading partner. If the orders are for prices away from the market price, then the order goes into the order book. The order book is a list of all of the buy and sell orders that are outstanding for a stock. For example, suppose the last trade for Ford Motor Company was at $10. Suppose you decide that $10 is too low to get you to sell your 100 shares, but you would like to sell them if the price ever rises to $10.50. You could place what's called a limit order to sell 100 shares at $10.50. A limit order is an order placed to buy or sell a set number of shares at a specified price or better. A limit order that doesn't get filled immediately goes into the order book. Let's say that a few minutes after your order goes into the book, Diane from San Antonio decides that she's willing to buy 200 shares of Ford if she can get them for $9.50 or less. Diane is in the opposite position from you, isn't she? No one will buy at your price, and no one will sell at Diane's price. Diane's order goes into the order book too. The order book has your offer to sell 100 shares at $10.50 and Diane's offer to buy 200 shares at $9.50. Other people will submit orders too, and sooner or later, someone will submit either an order to buy at the best offer price in the book or to sell at the best bid price in the book. When that happens, then the corresponding limit order on the book will be executed and the trade occurs. For a moderately popular stock, there are hundreds or even thousands of orders on the book, and the gap between the highest bid price and the lowest offer price is at most a couple of cents. With that many orders outstanding, all bunched around the same price, it's hard to think that the actual trading price could be too far from being fair. Remember, that doesn't mean that the price is correct. By tomorrow, the price will almost surely be higher or lower. But people like us can take comfort in knowing that lots of people were willing to buy or sell at prices just a few cents from the price we got. I'll sum up the idea that trading stocks is a contest this way. The search for the way to beat the market boils down to a contest, yes, but it's an information processing contest, and your competition is the accumulated information that all of the market's participants has discovered. If you're the type that likes to think of the glass as half empty, then only a very short list of true experts or insiders are going to beat the market with any consistency, and you're probably never going to be one of them. I prefer to think of the glass as half full. I think it's great that prices are almost always fair. It means that unless small fry like us run up huge trading costs, fail to diversify, or mess up our taxes, then we're pretty sure that we'll match the returns of almost all of the market players. But what about research that has found apparent market anomalies, trading strategies that at least seem to promise better than market returns? Professors R. David McLean and Jeffrey Pontiff studied 82 different return anomalies that at least suggested the promise of trading profits to investors who are smart enough to capitalize on them. McLean and Pontiff's new angle was that they studied what happened to these anomalies after an academic study drew attention to them. What do you think happened? If you think that the anomaly decreased or vanished completely, then you go to the head of the class. That makes perfect sense for two reasons. First, Some of those 82 anomalies were just quirks in the data. Even though the chances of any one person flipping either 10 heads or 10 tails are tiny, if 1,000 people each flip a coin 10 times, then the odds are good that somebody will flip 10 in a row. And yet, the odds are just 50-50 that this apparent expert will manage to do it the 11th time, despite his impressive track record. The same is true for academic research. If enough researchers study stock prices, then some of them are going to find trading rules that would have made money in the past. Trading strategies that fail don't make the news, though, so we don't have a good way to gauge whether or not the ones that appear to be successful really do reflect skill or whether they're just luck. We just have to wait until a few more years pass to see if they continue to work. The second reason that those 82 apparent return anomalies would decline after people learned about them is that easy money always attracts people who want a piece of the action. For example, several scholarly studies published in the 1980s showed rather conclusively that Mondays tended to be bad days for stocks. Maybe it was just bad luck. Maybe it was some underlying economic force that we didn't understand. But it didn't take long for savvy traders to start selling on Friday and buying late on Monday or early Tuesday. All that selling on Friday drove the price down on Friday so that Mondays didn't look so bad anymore. Maybe this so-called weekend effect was a statistical quirk, or maybe it traced to real economic forces. Either way, once the savvy traders acted on this information, the weekend effect pretty much disappeared. This seems to be the case for several other market anomalies. Any deviations from the fair price tend to be small, and they vanish quickly as clever traders cash in. Sooner or later, usually sooner, the strategies are discovered by other investors, and even if they really were good strategies once upon a time, then they don't work anymore. If there's easy money available, then somebody will grab it fast. Let's use the example of the January effect, sometimes called the turn of the year effect. Donald Keim, then a graduate student at the University of Chicago, generally gets credit for discovering this in the 1980s. Keim found that stocks, particularly small company stocks, seem to generate big returns during the first 5 days of January. What do you think investors would do when they learned this? Right. They started making their January purchases in late December before the price increased. They also delayed their December sales until January. That meant that clever investors had to buy even earlier in December or even in November and sell even later in January. Eventually, the pattern should self-destruct. Guess what? The January effect became undependable after it got noticed. Wall Street traders even joke that the January effect occurs on Thanksgiving now. Now it's time for a joke of a different sort. A professor and his student take a stroll. The student sees a $100 bill lying on the ground. As the student starts to pick it up, the professor says, "Don't bother. That $100 bill can't be there. If it were, then somebody would already have picked it up." Most people use this story to show how stupid the efficient market hypothesis is. I see a different lesson. Really, how many times have you found a $100 bill? I'll wager the answer is not very often, if ever. What's the point? The point is that there probably really is a $100 bill out there somewhere, but it doesn't pay to go out looking for it. There's probably an underpriced security out there somewhere too, but it probably doesn't pay to go out looking for it either. Professor John Cochran of the University of Chicago raises another subtle point about trying to beat the market. Remember, when I say beat the market, I mean beat the market after adjusting for risk. If you're willing to have a lot of bad years and really take a financial beating every so often, then you can load up on risky assets and probably have enough good years to beat the average market return over the long haul. But that doesn't make you a good investor. That means that you can handle lots more risk than most people. Professor Cochran's point is that what looks like a way to earn excess returns might really be just a way to take extra risks that we hadn't recognized before. For example, there's some evidence that what people call value stocks, for now, just think of stocks with low prices, tend to return more than the market even after adjusting for traditional risk measures. That sounds like a great idea to me. I'll just buy lots of different value stocks to be sure that I'm diversified. Then I'll sit back and beat the market in the long run. If I do that, though, I'll soon realize that I have a problem. All value stocks tend to move the same way. They tend to rise and fall together. I'm not as diversified as I'd thought, and I'm taking more risk than I'd thought. It's not clear that I'm really beating the market after allowing for this extra risk. Financial economists use the term efficiency to describe a market with prices that are fair given the information that we have at the time. Efficiency is a matter of degree. We all agree that the iPod and iPhone were tremendous successes that made Apple a lot of money when they were introduced in 2001 and 2007. But nobody thinks those particular bits of old news are going to affect the return he can make by buying shares of Apple today. The market is obviously efficient with respect to news that old. Most studies show that even very recent and much more subtle news won't give you an edge. Intel's stock price has gone up 3 days in a row, perhaps. That still doesn't tell you whether to buy or to sell on day 4. Kraft Foods opens a new facility. It's hard to imagine that's a surprise to guys who study the food industry for a living. But some news does help you pick winners and losers. For example, if you were Paul Moser in August of 1991, then you could indeed have made some money on some news. Moser was a Salomon Brothers bond trader who was the central figure in a Treasury bond trading scandal. Moser knew that he was about to be exposed, so he sold 46,000 shares of Salomon stock just 3 days before news of the scandal broke. The stock price dropped by a third in a matter of days. So no, the market was definitely not efficient with respect to this bit of insider news. If you can uncover news like this, then you can probably pick winners and losers. Although it's worth noting that trading on insider information like this is illegal. Moser got hit with a $1.1 million fine and was barred from the securities industry for life. Experts disagree on just about how efficient modern stock markets are, but most agree that stock markets are pretty darn efficient. Even those analysts and TV ads touting products that are supposed to make you rich agree that you can't pick winners. Not without their help, at least. Stock prices are almost always going to be extremely close to being fair to both the buyer and the seller. You might be thinking, I get the point that it's really hard for people like me to beat the market. But I'm hearing a lot of qualifiers, almosts, and usuallys when you talk about being unable to beat the market. Surely there are at least a few guys who can beat the market with reasonable consistency. Why don't I just have them manage my money for me? When I hear someone say that, I think of a line that comics from the Three Stooges to Yosemite Sam of Bugs Bunny fame have used for decades. All you have to do is find the gold and I'll share it with you. Most people laugh the first time or 10 they hear this. Really? Who would be so dumb as to do all of the work to find the gold and then share the prize with someone who does nothing? So let me ask you, why would someone who can consistently pick winners agree to manage your money for you and share his winnings with you? Shouldn't we see these skilled investment managers charging high fees instead? After all, if I can beat the market by 5% a year, then you'd be glad to pay me anything up to 5% in fees because you'll still be ahead. It seems to me that the skilled investment managers ought to be the ones getting rich, not their clients. Jonathan Burke of Stanford University and Richard Green of Carnegie Mellon University have devised a great story that explains a lot of things that otherwise would just seem crazy or irrational. For example, Why do people pay high fees? Why do they chase returns, pulling their money from their existing investments and putting it in last year's hot fund, even though the odds say that isn't likely to help? Why are funds that have a good year just as likely to have a bad year as they are to have another good year? In a nutshell, the story goes like this. Let's suppose that it really is possible for a few exceptional managers to pick winners, but that there's a limit to how many winners they can find. Setting limits on the amount of winners anybody can pick is certainly reasonable. People disagree on whether there are mispriced securities out there, but nobody claims they're easy to find. Besides, if a skilled trader tried to buy lots of shares in an underpriced security, then prices would begin to move against them. The stock would become fairly priced eventually. If you accept this story, that exceptional managers can pick winners but only in limited amounts, then Burke and Green's story can explain why some managers are willing to pick winners for you, why they can charge high fees, and why, despite picking winners for you, the investor, don't beat the market after paying those fees. And Burke and Green's story doesn't need to resort to market psychology, irrationality, or people making mistakes. Here's a numerical example. Let's imagine money manager Michelle, who can pick $1 million worth of stocks that will beat the market by 20% for the next year. That's rather amazing. This woman is really good. Let's suppose that Michelle charges her customers an annual fee of 1% of assets under management. To keep it simple, suppose that the market is flat over the next year. This means that Michelle earns 20% of $1 million, or $200,000, in abnormal returns because she can pick winners, making the fund worth $1.2 million. Michelle takes her 1% of the $1 million that the fund started with, or $10,000, and the smart investors who hired her happily divide the remaining $190,000 in extra investment earnings. Other investors will want a piece of this action, and because Michelle gets paid more for managing a larger fund, she's happy to accept more clients. Let's say the fund triples in size. The problem is that Michelle can still only pick $1 million worth of winners. Maybe she tries to find more than $1 million worth, but good as she is, that's her limit. She's good, but she's not omniscient. With $3 million under management, Michelle's fund again generates $200,000 on the $1 million worth of winners she picks. She only earns the market return on the other $2 million, though. She takes 1% of assets again, which is now $30,000. That leaves her clients with $170,000 in extra returns. Money manager Michelle's fund has beaten the market 2 years running. That makes for good advertising, so the fund attracts even more investors. How long can this continue? It continues until the fund has attracted $20 million. Michelle still generates an extra $200,000 by picking winners, but now she collects $200,000 in fees. Her investors are left with exactly the market return after fees. I love this story. It explains lots of things that seem so puzzling. Returns to investors are about the same on active funds that trade a lot and passive funds that trade very little. Check. Some funds earn extra returns by picking winners, but management extracts it in fees, so investors earn the market return. Check. Because the skilled managers are capturing the extra earnings they produce, anything they earn in addition to that, be it good or bad, is mostly luck. That means that good years are just as likely to be followed by a bad year as another good year. Check. That makes sense for investors to chase good past returns anyway, though, because they can't tell whether the fund had a good year just by luck or because it's too small for the manager to extract all the gains from his skill. Check. If the extra returns are just luck, then they're wasting their time, but if the extra returns are because the fund's too small, then they'll do better by switching into that fund, as long as they can switch before enough other people switch too. Burke and Green's story says that large fees can persist in funds that don't offer their investors anything more than the market return. Check. Managers with a history of good performance, like Michelle, make lots of money. Check. That's a pretty impressive list of explanations, isn't it? And nobody has to be irrational, and nobody has to make mistakes. Some of you might be asking, if it's so hard to pick winners and losers, then why don't I just buy a few shares of a whole bunch of companies? That way I might win a little here and lose a little there, but I'm just about guaranteed to get what everybody else is getting, even the experts, at least on average. In fact, that's the whole idea behind index funds and some exchange-traded funds. A financial intermediary, such as the Vanguard Group or Fidelity Investments, pools small investments from tens of thousands of investors, buys a large portfolio of many stocks, and distributes any earnings to investors in proportion to the amount they contributed to the pool. We'll talk more about these in Lesson 13. For now, though, take the existence of index funds as evidence that lots of people agree that it's just too hard to pick winners and losers. Some of you have another question. Okay, you say, suppose I accept the idea that people like us can't pick winners and losers, and that stocks are fairly priced, or at least close enough for us to act as if they were. Why should I bother to watch these lectures? I have a lot of answers for that. First, even if stocks are fairly priced, there are still lots of things you need to do to make sure that you tailor your investments to fit you. We've touched on some of those already. In Lesson 2, we learned about the two fundamental securities. Stocks are an ownership claim, while bonds are loans. Both of those might be fairly priced, but they are very different, and you want to be sure you get the one that's right for you. In Lesson 4, we learned about the historical returns and volatility of stocks. Stocks clearly offer the potential for hefty returns, but that comes at the cost of quite a bit of risk, too. You want to be sure you take the amount of risk that's right for you. In Lesson 5, we learned that diversifying is one of the closest things to a free lunch you're going to find. That's important even in a perfectly efficient market. Before trying to beat the market, think about the risk of your job. Is it secure? Then you can probably take more risk. If you live and work in Texas, the #1 state for crude oil production, do you really want to buy lots of stock in oil companies? If oil production stalls, then your job is at risk at the same time your portfolio suffers. Do you own a construction company? Construction is notoriously cyclical. Maybe it's best to buy more stocks that aren't so cyclical, like utilities. Let's conclude this lesson with an assignment. Watch a business channel and listen to analysts and commentators, or read a few articles about whether you should buy or sell a particular stock. The goal here isn't to decide whether to buy or to sell. The goal is to see how you feel while you listen to the pros and cons of a particular stock. I'll bet that when you listen to one analyst tell you the reasons to buy a stock, you'll tend to believe him. And when you listen to the other analyst tell you reasons to sell the very same stock, you'll tend to believe him instead. That's a perfectly natural reaction. I feel the same way myself. But if we're that easily influenced by talking heads, then I, for one, don't want to trust too much of my money to a strategy based on beating the guys who trade stocks for a living. We can do just fine without playing that game.